video, we're going to look at market efficiency theory. And we're going to run through about 7 or 8, maybe actually a lot of market efficiency theory questions that you may see on your exam. And we're just not only going to look at the solution, we're also going to use the framework that I really believe is an amazing one to use when doing these types of questions. Because it really remains to be a game of understanding, well, what is the actual information that's priced in the market or priced in the stock? And what's the information that is not priced in the stock? The reason why information that is not priced in the stock is like an important tool to understand is because if it's not priced in the stock, this means that investors could yield abnormal returns only on that type of information. So as you can see on the right-hand side of the screen, we have 2 frameworks, okay? We're gonna have this little framework here and this little framework here. And both frameworks are an attempt to kind of visualize the process, make this a little bit of an easier studying process for you. Okay, so let's jump right into it. This is really like the best way to kind of walk through market efficiency. And I'm sorry to tell you that on an exam, you'll never find the same questions as these ones. It's always going to be different, but at least you will know what type of framework, what type of model, and how do you want to read the contents to your advantage to really earn these like free points on your exam. The last thing I'd like to say is that if you go on my YouTube channel or on my website, you will find a really solid set of resources and videos dedicated solely on market efficiency theory. Really solid stuff that walks you through the rationale and the models that you want to put into play when you're doing these questions and just when like maybe you're studying the whole thing. So let's get into it. Let's look at this question. This is an exam-like question that's going to be touching on market efficiency theory, but we're going to be looking at a specific event and we're going to try to see whether it violates a specific form of market efficiency or several different forms of market efficiency. So let's read the question together. A fund manager's diligence study seems to suggest that his client can make abnormal returns. So already here we're like, whoa, his clients can make abnormal returns. All right. If he purchases oil company stocks, so he's going to buy specific stocks that were recommended in Warren Buffett's newsletters. Okay. And we're telling you which of the following best describe this event or what the fund manager decided to do. Now, once we've highlighted little bits and pieces of this question, it's really important to always look for the thesis, the angle, the technique that is taken by this person in this event, okay? If we take a step back, we notice that we have this fund manager. We could even be funny about this. We could even say we have this fund manager, okay? And this fund manager, what he does is that he helps his clients. So he helps clients like this to purchase stocks, okay? So they buy stocks. However, he helps those clients with a specific technique. And this technique is by reading up on Warren Buffett's newsletters and then buying a specific stock. So we could try to assess, well, on what type of information is this fund manager relying on? Well, he's relying on newsletters, okay? And we know that under the market efficiency like funnel, or I guess chapter, there's really 3 sorts of information that we care about, okay? And they're actually highlighted right here. There's past information, there's public information, and then there's private information. In this case, it is obvious that reacting to a newsletter, that's what we call public information. So we know right now that our fund manager is relying on public information, okay? Public information to yield above normal returns. So he's making abnormal returns by using public information. We know that. So abnormal returns by using public information. So if we go in our framework, okay, and we look at what's priced in, all right, and we look at what's not priced in, we understand that if somebody's able to make abnormal returns, okay, and I'll show you how to use both frameworks, either the first row or the second row. We know that if he's earning abnormal returns, we for sure know that it could be a weak form market efficiency. Because a weak form of market efficiency requires you to just not be able to make money using historical data. So you can make money using public or private data. So for sure, this is going to be this could happen in a weak form. However, if we look at the next phase, the semi-strong form, they're telling you that under a semi-strong form, historical and public data is priced in. So what does that mean? That means that investors cannot yield abnormal returns by either using historical prices or public prices. Okay, either or. Now that's really interesting because in this case, our little guy here, our fund manager, used public information to yield abnormal returns. So if we look at our framework, we're like, uh-oh, this is definitely, we could literally even do this, this is definitely not following the rules of a semi-strong form. And for that reason, if we go through A, B, C, and D, we could clearly see, all right, well, listen, this clearly seems to be a violation, right? This would be a violation of the semi-strong form market efficiency. So we could go ahead and say that this one's true. But then we'll still kind of run through A, B, C, D, and E. Let's look at A. A says that this would be a violation of all forms of market efficiency. But we said, as we went before, we said that this would not be a violation of the historical form. For that reason, A would be wrong. And for B, they're telling you that this would not be a violation of a semi-strong form market efficiency. But as you can see on our little structure here, that is false because it is a violation. So this is wrong as well. If you look at C, they're telling you that this would be a violation of weak form market efficiency. Well, of course not. As you can see, we did check. We did that's okay. So for that reason, C is false as well. And then E says that this would be a violation of weak form market efficiency. Already there, we know that this is no okay. So we know that this option is false as well. And for that reason, D is totally wrong. I mean, totally right. It's the only answer. All right. So that's how you would go about solving one of these exam market efficiency questions. It's really not that hard. And I'm going to show you maybe in the next question, a different angle that you could take. And really, I believe that would be the best angle. This one was slightly all over the place, but still it showed you how you would want to walk through it still because you'd uncover the basis of the question. So as you can see, the answer is D. All right, so let's look at this question here. So second question, this is going to be an event-based question of market efficiency, but we're going to look for something that is consistent with the event, something that is consistent with what was shared. Okay. So your friend Robert calls you to tell you that he has observed something super strange. Okay, something super strange on Blue Bottoms Corporation stock. Every time the stock rises more than 2.8% in a quarter, it will drop by 3.7% in the next quarter. So Robert's observation would be consistent with which form of market efficiency? Okay, this is interesting. And we'll kind of take a step back once again. Robert is not telling you to buy a stock or to do whatever with a stock, but he's definitely giving you an observation, okay? And that observation may have some sort of implication on the type of market we're dealing with. So here they're telling you that if the stock of a Blue Bottoms Corporation increases in one quarter, the next quarter it will decrease by a specific amount, okay? So that's interesting. And we're gonna try to put this in a funnel. In this case, Robert is telling you that he has looked at previous prices, right, in order to assess what will happen to a future price. He's telling you if you look at the past, I guess I'll write it at the top. If you look at past prices, you will be able to determine what will happen to future prices. That's pretty crazy. That's like some dark magic. And obviously, if you were to be, you know, a little investor, you would say, you know what? Well, I'm going to use that to my advantage, and I'm going to essentially position myself to the best possible extent towards Blue Bottoms Corporation. So you could use this to yield abnormal returns, right? You could look at this specific event, at this specific opportunity in which you're looking at past prices to determine future prices to yield abnormal returns. So if we go back to our framework, okay, we could look at, okay, well, what is priced in information? In this case, they're telling you, all right, that the prices of the past will have an implication on future prices. But under a weak form, they're telling you that that's not possible, that prices follow a random walk. So already here, you know that this is definitely not happening, all right? The rules under a weak form market efficiency are not being held. And for that reason, if the rules of a weak form market efficiency are not being held, this means that the rule for a semi-strong form will not be held and the rules for a strong form will not be held as well. Okay, so that's really important. So these are for sure no bueno. But what's really interesting is that if you look at this none of the above section here, you notice that if you are in a market that is not weak form, that is not semi-strong form, and that is not strong form, you would have essentially what we would like to call an inefficient market. And an inefficient market, all the information is not priced in. So past prices, public prices, and private prices, or I mean, past prices, public information, and private information is not priced in. And that means that people would be able to benefit from doing technical analysis. They would benefit by doing a study on past prices to be able to earn abnormal returns. That would only happen in that type of market, an inefficient market. So this is correct. Just like that, we use the framework to our benefit. Okay. So in this case, it's evident that we're dealing with an inefficient market because we know that this is not consistent with a semi-strong form. Under a semi-strong form, you cannot look at past prices to figure out what's going to happen to the price tomorrow or the price in the future or the price today. If that is inconsistent with the semi-strong form, for sure that's inconsistent with the strong form. And as we said at the very beginning, under a weak form market, you're not able to do a study of past prices to figure out the price of a stock today. For that reason, for sure, this is wrong. And these are wrong. E is wrong as well. And A would be the only correct option. Okay. So just like that, we know that A is correct. Pretty straightforward. And we just used our framework to our advantage. Literally as easy as that. That's awesome. All right, so here's a example that we covered on a crash course. You can look at that one. It's published on my YouTube, so no worries. We're just going to move on to the ones that we did not do. So we're going to go straight into this one. Whoops, hope you didn't see the answer. It could have been anything. But this one is another type of market efficiency question that relays or that relates to finding which of the following statements is most correct. Okay, and this one's interesting. So we got to read every single sentence and kind of make sense of it and try to put it into context with our structure. So which of the following is most correct? If capital markets are efficient, okay? If capital markets are efficient, then investors have no reason to believe that prices are too high or too low. That's really interesting. Investors have no reason to believe that prices are too high or too low. And the reason why this is facts is because a market is efficient. Investors will believe that the market is in equilibrium, that all of the prices lie on the SML, right? That nobody's able to yield a positive alpha, that nobody's going to lose money on their investment because they're confident that the market's efficient, that they're confident that everybody could react to prices in tandem, that everybody has access to the same information, and that all the information is priced in already. That includes past prices, public information, and private information. So there would be no reason to believe that a price is like all over the place, right? Investors will be rewarded effectively and adequately for the given level of risk they take. And for that reason, they would not believe that prices are too high or too low. They would not believe that they are able to beat the market. So already there, this is a pretty cool statement. We know that this is pretty bueno. Let's move on to the second one. B, if capital markets are efficient, then past prices, okay, so we're telling you if markets are efficient, by the way, if they're efficient, you are technically going to be right here, okay? This is where you're at. If markets are efficient, that means that they're strong form. And they're telling you that past prices will help investors, all right, beat the market. That means that investors could look at historical prices in order to beat the market. Now, what we could look at here is that we could look at what's priced in. We know that under a strong form of market efficiency, historical prices, public prices, and I always do this, historical prices, public information, and private information are all priced in. In other words, past prices will not help investors to beat the market because that information is already considered in the stock value. Okay, so for that reason, B has to be wrong. All right, now let's move on to C. If capital markets are efficient, once again, we're looking at if capital markets are efficient, then it is not possible to make money on the stock market. Now, this is actually interesting because some students will read this and say, oh, well, you can't make money as you can't make abnormal returns. But that's not what the question is telling you, okay? The question is like the little option here, C, it's not saying that you can't make money at all. It's not saying that you can only make zero returns. It's only, right? A capital market, if it's efficient, it's only telling you that you cannot make abnormal returns. In other words, that you cannot make an alpha. However, you could for sure make money. You could still invest. That's the whole value of the capital market, the opportunity to take on a little bit of risk to make higher rewards. All right. So saying that something that is impossible to make money, that's cap. That's false. All right. You're just not able to make an alpha. So C is not right. So please, on an exam, not mistake the notion of making money with the notion of making profits or making an alpha or yielding abnormal returns. It's not the same thing. Okay. Let's look at D. So D says if capital markets are efficient, so if capital markets are efficient, then investors can generate abnormal returns by studying publicly available information. Now, once again, you should notice by now that if we are at the portion dedicated to capital markets that are efficient, we know that it's strong form. And if a market is strong form, investors cannot yield abnormal returns based on historical prices, based on public information, or private information, because all of these are priced in. In other words, none of the above, so historical, public, and private, are not going to help investors make abnormal returns. For that reason, saying that investors can generate abnormal returns because they're studying publicly available information, that's cap. That's no bueno. That's not right. For that reason, D is wrong as well. And we could say that D is wrong. For that reason, A is correct. That is the only answer that would be bueno here. Let's go ahead and kind of just clear framework. And we're going to use it again moving forward. So yeah, it's really, it's not that hard. We're just building off questions one by one. This one's pretty cool too. All right. This one's pretty cool as well. All right, so this one's going to be which of the following is most correct, okay? So we're going to read through these one by one. We're going to try to make sense of this. So notice how there's like 6 options. It's pretty crazy stuff, but we're going to be able to go through this. So this is a market efficiency question related to which of the following is most correct. They're going to give you a bunch of prompts, and this one's particular because it touches on CAPM as well, okay? It's pretty cool. So let's go with A. Investors who study public information, already there, they're telling you what type of information is being studied, can earn returns above those predicted, okay, by the SML under a semi-strong form market efficiency. This could kind of put some students off. Like this could be kind of strange for some students. But we could break this down into 2 like buckets, which will make this simple. So we know for sure that students are going to be, investors are studying right now some sort of public information. And thanks to this public information, they could yield some abnormal returns, okay? And they can yield returns that are above the SML. But what does that mean? Well, having returns that are above the SML, simply, it could be drawn as something like this. Remember our SML, we have our beta on our horizontal axis or x's, and we have our returns on our vertical axis or y-axis. And we have, the classic, put it in a different color there, classic SML, just like that, right? And we would say, for example, if I use pink, that this point here could be expressed, sorry about that, I'm just gonna make it a little clearer. Could be expressed, I'm sorry, I'm like really trying to make this somewhat nice. Okay, cool. So we have this point right here, which is going to be our ERM. And this is beta is equal to 1. Okay, So that's essentially our classic CAPM little visualization tool. It's our classic SML. But the real key takeaway here, and I'll draw it out for you, is that any point, right, that's beyond, right, that's like here, beyond our SML, and any point that's below our SML, well, there's actually some really important takeaways to have here. I'll draw them out for you. If something is, I guess, I'll zoom in a little bit just to make it nicer, and you'll see why this matters. You probably already know what I'm going to say. I'm like a broken record, but this is relevant for those who've just been doing this for the first time. I'm just trying to make an arrow. There you go. So if it's above the SML, right? If you have a point above the SML, let's say right here, or I'm gonna go somewhere better, like right here. This would mean that for that expected, that level of risk you're undertaking, you're actually making more returns than what is expected by the SML. So you're making an alpha. You're actually making more returns for that given level of risk. And we would say that an asset is underpriced. And what's really important here is that if an asset is underpriced, it is considered to make returns above the SML. And in other words, it's considered to make returns that are abnormal, okay? That they're no bueno. That are bueno, but that shouldn't exist, okay? And if we do the same thing with our, I'm really trying hard to, okay, hold on. This should work. There you go. Sorry about my 3-year-old capacities using Notability. But what's awesome is that if it lies below the SML, we would say that something is overpriced because for that given level of risk, you're actually being undercompensated. And that's not good, okay? Investors don't like that. And if it's on the line, we would say that it is fairly priced, okay? So now that we know this, we could take a step back. All right, I'm going to zoom out a little bit. I don't know why it's not letting me zoom out. Strange. Okay, whatever. There you go. Sorry about that. Sometimes my stuff don't work so well, but it's part of the game. So with that, this is really cool because now we know that if returns are above those predicted by the SML, as it's saying here, this means that we're making abnormal returns. So we're making abnormal returns by studying publicly available information. However, if we're studying publicly available information, and I guess public information, oh, whoops, don't want you to see the answer. It means essentially that if we were under a semi-strong form, we would be essentially, we wouldn't be following the rules. Because if we were under a semi-strong form, we wouldn't be able to use public information to beat the market. The only place where we could use public information to beat the market is under a weak form or a inefficient market. So for that reason, saying that investors can study public information to earn abnormal returns under a semi-strong form would be wrong. It would be capped, as the young kids like to say nowadays. So A is wrong. All right. Now, if we go to B, B says that investors who study information which hasn't been made public, okay, hasn't been made public, can earn returns. So earn returns above those of the SML under a semi-strong form. Now, this is getting interesting because now we're in a semi-strong form still, but we're telling you that we're using private information. If something isn't public yet, it's obviously private, right? I feel like that's what it is. But it's obviously private. And what's awesome is that if we go back to our structure, is we know that there are places at which private information can be used to yield abnormal returns. It could be used in a weak form market. It could be used in a semi-strong form market and in an inefficient market. And in this case, we're telling you, hey, under a semi-strong form market efficiency, investors are allowed to use private information to make an alpha, to make abnormal returns. Well, if you look at your structure, you could do so in a weak form, you could do so in a semi-strong form, and in none of the above. So this is true. This is totally fine. This is okay. B is okay. That's awesome. Now, if we go to C, investors who study historical prices. So they're going to study historical prices, could earn returns above those predicted by the SML under a weak form of market efficiency. Now, if we go back to our framework, okay, really as easy as that, we know that investors could only earn okay, could only earn abnormal returns if they study historical prices under one type of market. And that's going to be right here under a none of the above, an inefficient market, because private information would not be, private, historical prices would not be priced in. So that's the only instance at which investors could do so. Saying that investors could do so in a weak form, well, that's totally wrong, because in a weak form, historical prices are priced in, and only public and private information is not priced in. So for that reason, this is not good and this is good. So this would only be in an inefficient market. For that reason, C is capita cap. It is no bueno. Okay? So we would say that C is no bueno. Now we could move on to D. All right, and by the way, like some quick, taking tests 101, if you know that A and C is wrong, for sure E has to be wrong, because they're saying all of the above. So that's no bueno. And then F is saying that C is correct. We know that C is wrong. So F is incorrect. So we know that our answer could only be between B, D, and G. So now instead of having an odds of like 1/6, your odds are 1/3. Your chances of getting this question correct is much higher. So this is just some quick, probability game they could use to your advantage when taking a test. But let's look at D. Investors who conduct fundamental analysis. Well, whoa, what is fundamental analysis and where do we see fundamental analysis? Remember that fundamental analysis is the study of historical prices, okay? And now they're telling you that investors who conduct fundamental analysis could earn returns above those predicted by the SML, okay, within an inefficient market. So under an inefficient market. And if you saw what we did for C, well, of course, yeah, 100%. We could use historical prices under an inefficient market. And for that reason, D is true. And just like that, we know that B and D is correct. And we know that G then must be correct. So G is the answer. All right, boom, just like that. And now we can move on to another one, another question. All right, so let us just clear our framework. We're going to be almost done with market efficiency. It's as easy as that. It's awesome. Okay, so another exam-like market efficiency question, which is going to ask you to find which of the following is most correct. This question, we're asking you, and I guess I'll switch colors to something that's, kind of dope. This question they're asking you, hey, for A, market efficiency theory studies to what extent market prices reflect all private information. So we're talking about market efficiency theory, but they're also telling you to what extent market prices are reflecting private information. But low-key, market efficiency theory kind of reflects more than just private information. So I'm not too sure if this is right or if this is wrong. If I want an exam, I'm like, this is not like the most correct answer. Perhaps there are better, answers out there. So let's look at B. If we look at B, weak form market efficiency implies that investors, so we're looking at weak form market efficiency, and investors can earn abnormal returns, okay, only by studying private information and historical data. Well, the private information piece is definitely correct. However, the historical data piece is no bueno, because if we look at our framework under a weak form market efficiency, we know that under a weak form market efficiency, only public and private information is not priced in. Historical prices are priced in. For that reason, investors could only yield abnormal returns by studying either public or private info. They're telling you that they could also study historical info. It's cap. That's no bueno. So B is for sure wrong. And if B is for sure wrong, we know that saying that E is like that all of the above is right is cap. That's not good too. So E is definitely wrong as well. So now instead of having 1/5 as our odds for this question, our odds are now 1/3. That's not too bad. Okay. Let's move on to C. Weak form market efficiency, so we're still dealing with that, implies that stock prices follow a random walk, and there would be no use in studying, okay, past prices to earn abnormal returns. Now I'm liking this. This is like the gospel, because this is so true, all right? Weak form market efficiency implies that stocks follow a random walk. A random walk means that the price of a stock yesterday or before will not have an effect on the price of a stock today. That's some beautiful stuff. That is true. If you remember our little video on weak form market efficiency or just total like efficiencies for a market. But they're also telling you that if you study past prices, there would be no use to earn abnormal, like you won't be able to earn abnormal returns. And in our framework, as you can see right here, that's exactly what we pinpointed. So C is definitely true. C is okay. And if C is okay, D is no way okay, right? Because none of the above is capped. C is definitely true. And it goes back to us being kind of smart now. We know that A wasn't the cutest, statement. And for that reason, it's probably not correct. And for that reason, we will choose only C as being our answer. Just like that, we are good. Okay, so we have another one. We have another one. Okay, yeah, it stops there. I'm going to erase the stuff that we have on our framework so we can use it again. And in this question, another exam-like question, but this time I'm going to ask you which of the following is not correct. Okay, so we want to find the wrong answer. So let's begin with A. If capital markets are efficient, then investors have no reason to believe that prices are too high or too low. We literally covered that prior. We know that if capital markets are efficient, investors would have no reason to believe that prices are too high or too low. So for me, that's definitely true. And for that reason, that's not what we're looking for because we want to find what's not correct. So if capital markets aren't efficient, so if we're dealing with inefficient markets, then the difference between the market value of an investment and its costs will not be zero. Whoa, what are we talking about here? Between the market value of an investment and its cost will not be zero. So what they're saying here is they're telling you, hey, your expected return versus your K, typically, if markets are efficient, it should be equal to zero. The difference between the two should be equal to zero. However, in this case, we're telling you that the difference between the two will not be zero if capital markets aren't efficient. Let's think about that, right? If capital markets aren't efficient, that means that investors could yield, abnormal returns by studying past prices or historical information, by studying public information, and by studying private information, like any of the above. So that's like bad news because they could earn an alpha in so many different ways. For that reason, well, saying that the difference between the market value of an investment and its cost will not be zero, well, it's true. It won't be zero because people will be earning alphas left, right, up, and down from all sides. For that reason, B is definitely like correct. And for that reason, it's not what we're looking for. If capital markets are efficient, okay, capital markets are efficient, then the difference between the market value and an investment, and it will essentially between the expected return and K will be zero. Well, that's also true. That also holds. So for that reason, C is not good. And well, obviously, if these three are wrong, if you're taking an exam, you're gonna go for the one that's that's left. But let's work through it. If capital markets are efficient, okay, then the difference between the market value of an investment and its cost will be equal to the market risk premium. But we know, and we literally just said so for C, that if capital markets are efficient, all expected returns will lie on the SML line. In other words, the required rate of return of an asset for that given level of systematic risk will be exactly the same as the expected return of that given asset, such that if we do expected return minus K, we would get zero because there is no alpha, there is no way to yield abnormal returns. Everything is in equilibrium. So saying that the difference between ER and K would be the market risk premium is cap. No way. There's no way that that's true. Okay, there's no way that that's true. And for that reason, D is what we're looking for. D is good. D is exactly what we want. I mean, that's what she said. But D is the correct answer. Okay, there's more somehow. Okay, that's fun. We could go for more. Yeah, okay. So another one which looks for which of the following is not correct. We're just going to go and clear up our framework and we'll solve for this together. So which of the following is not correct? So if we go with A is telling you that insider trading can help investors. So it could help investors earn abnormal returns if markets are weak form efficient. Now we've literally highlighted the word weak form efficient. So all that you got to do is go in your framework and look for weak form. And you could look at what is the information that's priced in. So the information that investors could not use to yield abnormal returns. And what is the information that is not priced in? So the information that investors can use to yield abnormal returns. And you notice that public and private information can be used to, get an alpha. And in this case, insider trading is the use of private information, and under a weak form market efficiency, that's totally it's not okay legally, but it's something that could happen. It's something that can be done. So A is definitely true, and for that reason, A is not good. That's not what we're looking for. Now, if we go to B, insider trading can help investors earn abnormal returns. So we're still dealing with the same little guy here, abnormal returns, if markets are strong form efficient. Ooh, so if markets are strong form efficient, we could go jump back straight to our framework. So once again, we're dealing with private information. And we notice that under a strong form market efficiency, we know that, listen, historical information, public information, and private information is all priced in, okay? Such that none of the above that we just mentioned is actually not priced in. In other words, investors could not earn abnormal returns with any of those bad boys. And for that reason, if you are in a strong form market efficiency, you can't get abnormal returns by using insider trading. And for that reason, this is incorrect. And this is actually what we're looking for. So already we have our answer, but we could kind of continue forward just to make sure that you have the frameworks that are needed to solve such a question. Maybe one portion of it will be in a different multiple choice, right? So let's go with C. If capital markets are efficient, okay, all information, public, private, and historical, are considered to be priced in. I mean, that's the gospel again. This is what I like to see, this is what I like to hear. All right. If we go back to our framework, we said price and information under a strong form of market efficiency consists of historical information, public information, and private information. And for that reason, C is extremely true. For that reason, that's not what we're looking for. So let's go with D. Capital markets are inefficient, okay? If capital markets are inefficient, investors can earn abnormal returns, right, by surveying historical prices. Historical prices is past information. If we go to our framework, if we're looking at an inefficient market, we will be right here. And we know that the information that is priced in, so the information that investors could not use to earn abnormal returns, well, there's actually nothing. It's pretty crazy. But the information that investors can use to yield abnormal returns, to yield an alpha, well, it's actually historical information, public information, and private information. And in this case, we're telling you that investors could survey past prices, so they could look at historical information and earn abnormal returns. Therefore, we could say that D, is definitely true. And for that reason, it's not what we're looking for, such that B is our answer. Okay. We got one more. Every time, we got one more. We got one more market efficiency question. But just because I feel like I'm just repeating myself, because I'm under a semi-strong form, blah, blah, blah. So at a certain point, my brain is it's just on autopilot. And it's not as fun when I'm on autopilot, just because I kind of forget what I'm saying. Sometimes I say mistakes or stupid stuff. Well, I mean, I say stupid stuff a lot. But anywho, another format of market efficiency question in which we're still looking for one of the statements that is not correct. So there's going to be at least 3 statements that are correct and 1 that is false. It's like the game we used to play in elementary school. Which one of the 3 statements is a lie? So under a semi-strong form market efficiency, okay, stock prices reflect all historical information and public information. I'm liking what I'm seeing so far. However, it does not include information available only to insiders. That's not bad. That's pretty correct, because they're telling you, if we go to our framework, that, okay, we're under a semi-strong form, okay, of market efficiency. And they're telling you so far that the information that is priced in, yeah, 100%, it's historical information and public information. And it does not include private information like that is available to insiders. So far so good. Like A could be correct. What I used to do on exams, I would put a little line underneath if I'm not too sure. But this seems like this is correct. Now let's go to B. B says that under a weak form of market efficiency, stock prices reflect all historical information and public information. Already there, you could stop, right? Because we know that under a weak form of market efficiency, there's only one type of information that is priced in. In other words, there's only one type of information that investors could not use to benefit and to yield abnormal returns. It's historical information. For that reason, we know that under a weak form of market efficiency, investors could benefit by using public and private information. So in this case, this thing right here, which I'll highlight in purple, well, this is really what we shouldn't have. Okay, so B is definitely incorrect. And this is probably something that we like because we are looking for something that is incorrect. Let's move on to C though. C says that under a weak form market efficiency, stock prices reflect all information that can be gathered by conducting technical and fundamental analysis. If you recall, technical and fundamental analysis are practices that are essentially surveying past prices. And these practices have been discussed in detail within the weak form of market efficiency bucket. So you should really have that active recall, right? Like, okay, technical, fundamental analysis, random walk, all of these topics are discussed within the weak form of market efficiency. And in this case, if they're telling you that under a weak form of market efficiency, stock prices reflect all the information that could be gathered by using these practices, well, they're literally telling you, hey man, you can't use these techniques to yield abnormal returns because all of the information you would get is already being priced in. Everybody has access to that. So this is actually true. So this is definitely correct. So C is not the answer. Now, under a weak form of market efficiency for D, we're telling you, you believe that stock prices follow a random walk. And that's like hella true because saying that stock prices follow a random walk is synonymous to saying that the price of a stock yesterday will not affect the price of a stock today. In other words, that you can study all the prices of the past that you want and it will have zero effect or it'll yield zero tangible like IP or intellectual property or like takeaway for you in order to figure out what position to take on the market the next day. All right, so for that reason, D is totally facts. So that's no bueno, we don't want that. And when we take a step back, now we're between A and B, but B definitely looks like the most incorrect. So B is definitely the one that we're gonna go for. B is gonna be our answer. And A, in this case, seems like it's correct as well, so we're not gonna go for it. And in this case, as you can see, B is the answer. And we're done with market efficiency. Okay, we're done. Woo! It's the stuff that nobody likes to do, but it's actually pretty logical, especially if you use the framework that's provided right here. Like, I mean, why not use it? It's so simple. And with that said, I really do recommend that you watch the resources that I have on my YouTube channel that are related to market efficiency, because there's about like another like 10 questions or so that I walk through on my YouTube channel. And I also spend some time really outlining why these frameworks work and what's the rationale, right, behind market efficiency theory and why it really matters for us. Okay, it's really important. It's actually really important for you that market at least tries to be efficient. That's why we have laws, regulations, and governing bodies who supervise markets on a very, very like continuous and daily basis. It's like important. Anywho, I feel like I was talking a lot here, but that said, I hope this video helped you out. I hope this gave you a different way to look at these types of questions. It gave you exposure on different topics and mindsets and models to take here, and that it empowers you just a little bit. Yeah, that said, a bunch of resources available on these helps. Hopefully I see you in another video. Yeah, this is just an attempt to kind of help out. All right, so see you next time. Au revoir.